In March 2025, the Federal Reserve updated its eligibility requirements for direct Treasury purchases through TreasuryDirect. You probably didn't notice. Most people didn't. But here's what changed. Individuals can no longer open new accounts to buy treasuries directly from the government if they hold more than $10 million in existing Treasury securities across all accounts. That sounds like a rich people problem until you realize what it actually means. For the first time in decades, the Fed is creating a two-tier system for who gets direct access to government debt. And the threshold isn't static. It's a policy lever they can adjust whenever they want. I started tracking this when the Treasury Department quietly updated its terms of service in February. No press release, no announcement. Just a footnote in a 47-page regulatory update. What I found isn't about punishing wealthy investors. It's about steering demand. Because when you can't buy treasuries directly, you buy them through intermediaries, banks, brokers, funds, and every intermediary takes a cut. This matters if you own treasury bonds, treasury ETFs, or money market funds. Not because your holdings are in danger, but because the infrastructure for accessing the safest asset in the world just became less accessible. And infrastructure changes always redistribute who benefits. If that sounds useful, stay. Hit subscribe, and if this helps, give it a like. But this is the kind of shift that makes sense only after everyone's already repositioned. First, let's get clear on what TreasuryDirect is, because most people have never used it. TreasuryDirect is a website run by the U.S. Department of the Treasury that lets you buy government bonds directly. No broker, no bank, no middleman. You create an account, you link your bank account, you buy treasury bills, notes, or bonds at auction. The government sends you the interest. When they mature, you get your money back. It was launched in 2002 to replace the old paper savings bond system. The idea was simple. Give retail investors direct access to the safest investment in the world without forcing them to go through Wall Street. And for over 20 years, it worked exactly that way. As of 2024, TreasuryDirect had about 1.5 million active accounts. That's tiny compared to the total treasury market. Most treasuries are held by institutions, foreign governments, and funds. But those 1.5 million accounts represented something important: unmediated access. If you wanted to own a treasury bill, you didn't need a brokerage account. You didn't need to pay custody fees. You didn't need to buy an ETF with an expense ratio. You just bought it directly from the source. And that's what just changed. February 14th, 2025. The Treasury Department updated the TreasuryDirect Terms of Service. Buried on page 34, section 12.3, there's a new eligibility restriction. Individuals holding aggregate Treasury securities exceeding $10 million across all TreasuryDirect accounts are ineligible to open new accounts or purchase additional securities through this platform. Effective March 1st, 2025. If you already had an account and were under the threshold, nothing changed. You can still buy treasuries directly. If you already had more than $10 million, your existing holdings were grandfathered. But you can't add more through TreasuryDirect. And if you're a new user who happens to hold $10 million in treasuries elsewhere, through a broker, a fund, anywhere, you can't open a TreasuryDirect account at all. Now, $10 million sounds like a lot. Yeah, and for most people, it is. But here's why this matters, even if you're nowhere near that number. 1. It's a precedent. This is the first time the Treasury has ever restricted access based on holdings. The threshold exists now, and thresholds can be adjusted. 2. It reveals intent. The government didn't need to do this for operational reasons. TreasuryDirect handles a tiny fraction of total issuance. This was a choice. And 3. It changes the relationship between individuals and government debt, because once access becomes conditional, it's no longer a right, it's a privilege, and privileges get adjusted based on policy goals. So, why would the Treasury Department restrict access to TreasuryDirect? It's not about revenue. Treasuries get sold either way. Whether you buy them directly or through a broker, the government gets the same amount of money. It's about flow control. When you buy a treasury through TreasuryDirect, the government knows exactly who you are, how much you own, and where it sits. But that information stays in a silo. It doesn't flow through the financial system. When you buy a treasury through a broker, suddenly there's visibility. The broker reports your holdings. The Fed can see aggregated data on who's buying, who's selling, and how much liquidity is in the system at any given time. That visibility matters when you're trying to manage monetary policy. But there's another reason, and it's more direct. Intermediaries make money from Treasury transactions. Not a lot per trade, but at scale, it adds up. Custody fees, transaction fees, bid-ask spreads, expense ratios on ETFs, yield drag on money market funds. Every time a Treasury changes hands through the traditional financial system, someone takes a small cut. When you buy directly through TreasuryDirect, nobody takes a cut. The government sells you the bond at auction price. You hold it. It matures. Done. That's efficient for you. But it's bad for the financial intermediaries who make money facilitating Treasury transactions. And here's the thing. Those intermediaries are the same institutions that buy the bulk of new Treasury issuance. They're the primary dealers, the banks. The broker-dealers who participate in auctions and distribute Treasuries to their clients. And the Treasury Department needs those institutions to keep buying. And one way to keep them happy is to make sure retail demand flows through them, not around them. This isn't a conspiracy. It's just how the system works. When the government needs to issue $2 trillion in new debt every year, it pays attention to the institutions that make that possible. And if those institutions prefer that retail investors buy treasuries through them instead of directly, well, infrastructure gets adjusted. So, what does it actually cost to buy treasuries through an intermediary instead of directly? Let's run the numbers. Say you want to invest $100,000 in short-term Treasury bills. You plan to hold them for 10 years, rolling them over as they mature. Option 1, TreasuryDirect. You buy directly at auction. No transaction fees, no custody fees, no management fees. You earn the full yield. Right now, that's about 4.5% on a 6-month Treasury bill. Over 10 years, assuming rates stay roughly the same, you'd earn about $45,000 in interest. All of it goes to you. Option 2, brokerage account. You buy through Schwab, Fidelity, or Vanguard. Most brokers don't charge transaction fees for treasuries anymore. That's good. But they do charge custody fees for holding the bonds. It's usually small, 0.05% to 0.10% annually. Let's say 0.08%. On $100,000, that's $80 per year. Over 10 years, that's $800 in fees. Not terrible, but it's $800 you wouldn't have paid through TreasuryDirect. Option 3, Treasury ETF. You buy a Treasury ETF, like SHV, short term, or IEF, intermediate term. SHV has an expense ratio of 0.15%. That comes out of your returns automatically. On $100,000, that's $150 per year. Over 10 years, that's $1,500. Plus, ETFs have a slight tracking error. They don't perfectly match the underlying Treasury yields because of operational costs and cash drag. On average, you'll earn about 0.10% less than the actual Treasury yield. Over 10 years, that's another $1,000. Total cost, $2,500. Option 4, money market fund. You park your money in a Treasury-backed money market fund. These funds typically yield 0.30% to 0.50%, less than direct Treasury ownership because of management fees and operational costs. Let's say 0.40% yield drag. On $100,000 over 10 years, that's $4,000 in lost returns. So here's the summary. TreasuryDirect, $0 in costs. Brokerage, $800. Treasury, ETF, $2,500. Money market fund, $4,000. These aren't huge numbers, but they add up. And more importantly, they're permanent. The efficiency of direct ownership is being replaced by a system where someone always takes a cut. That's fine if you get something in return. Better tools, easier access, automatic reinvestment. Sometimes intermediaries are worth it. But when the direct option gets restricted, you don't get to choose anymore. You just pay. If you're holding less than $10 million in treasuries, this doesn't affect you right now. You can still open a TreasuryDirect account. You can still buy bonds directly. Nothing about your access has changed. But here's what I'd pay attention to. 1. Thresholds move. When the IRS created the accredited investor rule in 1982, the income threshold was $200,000. That seemed high at the time. Today it's still $200,000, which means inflation has slowly expanded who qualifies. That was intentional, but it also means thresholds can move the other way. The $10 million limit on TreasuryDirect could stay there forever, or it could get adjusted to $5 million, or $1 million, or $500,000. Once the infrastructure for restricting access exists, changing the number is easy. 2. Precedent matters. Now, this is the first time the Treasury has ever said, if you own too much, you can't use this service. That sentence didn't exist before February 2025. Now it does. And once a restriction exists, it's easier to expand it than to create a new one from scratch. 3. The direction is clear. Direct access to financial infrastructure is being replaced by intermediated access. You see it with payments, you see it with banking, you see it with investing. The trend isn't toward more direct ownership. It's toward more layers between you and the underlying asset. Each layer adds cost. Each layer adds control. That's not necessarily bad. Intermediaries provide services, liquidity, convenience, customer support. But when the choice between direct and intermediated becomes a policy decision instead of your decision, the balance shifts. And it always shifts in favor of the intermediaries. So, what should you do with this information? If you already have a TreasuryDirect account and you're under the $10 million threshold, nothing changes. Keep using it if it works for you. If you don't have a TreasuryDirect account and you want the option of this direct treasury ownership, consider opening one now, even if you don't plan to use it immediately. Because once a threshold exists, it can move. And it's easier to have the account before the rules change than to try to get access after. If you hold treasuries through a broker or an ETF, understand the cost structure. Know what you're paying in fees, expense ratios, and yield drag. Sometimes it's worth it. ETFs are more liquid than direct holdings. Brokers offer better tools for managing a portfolio, but know the trade-off. And know that the free option, direct ownership, just became less accessible. Beyond that, this is about pattern recognition, not immediate action. The safest asset in the world is being quietly restructured, not in terms of credit risk. Treasuries are still backed by the U.S. government, but in terms of access. And access changes always redistribute who benefits. If you're paying attention now, you get to adjust before it becomes obvious. If you're not, you'll just wake up one day and wonder why buying treasuries got more expensive. So here's where we are. In February 2025, the Treasury Department restricted direct access to government bonds for anyone holding more than $10 million. Most people didn't notice. It didn't make headlines. It was a footnote in a regulatory update. But it's the first time in the history of TreasuryDirect that access has been conditional on how much you already own. That's a precedent. And precedents don't stay static. The threshold might never move, but it might. And once the infrastructure for restricting access exists, adjusting it is easy. This isn't a crisis. Your treasuries aren't in danger. The government isn't seizing bonds. But the relationship between you and the safest asset in the world just changed. Slightly, quietly, and infrastructure changes always matter more than people think. I'll keep tracking this. I'll keep reading the regulatory updates nobody else bothers with. I'll keep documenting when the rules shift. If that's useful, subscribe. If this helped, hit like. Otherwise, I'll see you in the next one.